Hello, X-Traders, and we are going to dedicate this video to the paper hands traders. You're going to hear me say that a lot, and the reason is because I identify as one of those. And just to, set the record straight, a uh, a diamond hands trader, diamonds being hard, refers to that kind of trader who can look at this chart and see it go up and up and up and up and up, and then all of a sudden it retraces, but he's okay with that because he knows that there's more potential, and then he makes out with more profit, from whatever here to here was, and then, was basically able to hold on to that trade for longer and squeeze out the most amount of profit possible. Now, some of you are going to say to me, well, but we always hear about, you always need to leave money, or you should always leave money on the table because you don't want to, let a green trade go red. And that's true, and that's fine. But, it's just a thing. It happens. Some people have it, some people don't. I think it's best to realize that you don't when you don't. You might get it later, but I identify as a paper hands trader, paper being softer, obviously, than diamonds, and I am definitely the kind of trader that gets out here. Okay, obviously, the reason why I say you might turn into a diamond hands trader later on is because the better you get at technical analysis and the more keen or in tune you are with other fundamental aspects of the economy, the sectors and industries, or the ticker in particular, you might learn to spot, as what not just fundamental levels but technical levels, and the combination of both optimally, that will somehow, let you see that this is as far as this thing goes, and then if you're here, then there is more upside to go, and there's no reason why it should really stop at this level. And therefore, after this run up, you look at your levels and your analysis, and you think to what's going on in the market, and you're like, no, Netflix has a little bit more juice left in it, and this is not a previous level, or it's a weak level, or it's not such a highly contested or previously multiple touch level, so that makes it a weak one. And then when it reaches this one, you're like, okay, this thing works. This thing has been resistance a few times, and then it turns into support. So you know that this is an important level. So somewhere down the line, you recognize that this is a more solid level. And so that, if you're ever waiting for this thing to come down, you know that it's going to come down to this level. You realize that if it comes down from 318, whatever this is, 319, down to 282, you're like, yeah, this is excuse me, this is a support, but it's not that good a support, not that solid a support, not that of a long-term support. This is much more long-term. If the market keeps turning bearish, then this thing is definitely going to blow through this, and I'll hold it as a diamond hands trader that I am, because I have all this knowledge and experience that tells me that this is probably going to turn out to be a weak level, and then boom, you make that extra 20, 30, maybe 50%. So that's what we're going to we're not going to focus on how to get technical and fundamentally savvy. That happens over time. We're going to basically focus on those paper hand traders that make it through that first climb, and are too, because you might get in here, but you might also get in on here after it breaks, let's say, this resistance. So how do you avoid selling too quickly? Okay, this is not going to teach you how to avoid selling too quickly, because that translates to how do you become a diamond hands trader. I'm not going to be able to teach you that in one video. I'm not even one myself. So what I'm going to teach you is how to trade given the fact that you know that pullbacks or retraces, whatever you want to call them, in the market happen. So how do you trade and not not get so jittery? That's basically the point. All right, so let's jump in and see what happened. This is the daily, and there was, if you were to draw levels on this like extremely quick without giving it too much thought, I would say, okay, this thing is trading in a channel, it looks like to me, and so actually, if this is a channel, sorry, I've had a terrible cough the past few days. Okay, so let's actually use the channel tool. And this looks like that channel. Boom. And it's going to work all the way down to here. Don't try to capture every single move in a channel. Try to, pick the ones with the most touches. So I'm going to actually stick to this one here. Okay, so this is the channel range that I see Netflix trading on. Now let me just add, if I remember, because I don't use Thinkorswim that much. Arrow. Yeah, let's go ahead and use this arrow. So I believe that this is where this trade, sorry, not there, a little bit earlier. How do I always forget. I believe it's this one. So I want to activate this drawing so that I can move it. I haven't used this in a while. So you see this bullish hammer right there? Let me zoom in on that. I think this is the tool for zooming in. I'm just going to focus on this like little M, W, whatever pattern, 3 drives pattern. I don't know what those things are called. Okay, so here it is. I'm going to move this thing again. Okay, so I want to make that extra large. Oh, wow, great. Well, that's not much difference. Okay, so this is where an alert was made. Okay, and this was on November 22nd. Okay, so this is where the alert was made a few days ago. And the alert was for a call. It was for a call. It was for a 3:30 December 16 call. So the trader, the analyst, was giving himself a lot of time for this thing to go back up to 3:30. Let me see if I can get 3:30 in here. Okay, all the way up to here. So he was basically thinking that, that this thing, because of course this is only up to December 7th. So, I'm missing a few bars over here, but I'm sure that this top trend line reaches and passes 3:30 if you extend that channel out to December 16. So I'm thinking that this analyst was, he noticed this bullish hammer here, and he figured, oh, this thing is going to rocket up and reach 3:30. Okay, so immediately, if you if you don't have in your toolbox a lot of these things that you pick up over time, like I said, like an ATR, which is the average true range. And basically an ATR takes the average of how much in dollars a particular ticker moves over the past 14 or 20 days. You can adjust it to whatever you want. And comes back and says to you, this thing moves on average $2 a day. So okay, if you're on November 11th and you're shooting for December 16th, that's about 20 or so days. If this thing moves $2 a day in 20 days, that's $40. And we're at 285. $40 puts us at around 320, right? So the analyst took it upon himself to call the 3:30 call for December 16th, giving himself enough time. I don't know if he used ATR, I'm not sure. But the thing with a paper hands trader, such as myself, is that if you go back, and I've been looking up at this bar, I can't find it, to be honest. There is a way to tell Thinkorswim, or to have Thinkorswim go back in time and show you. For some reason, I'm not seeing it. I wonder if it has anything to do with the fact that I'm on simulated trading. Show you whether, what the price for a particular options contract was way back when. Let me see if this has anything to do with it. No, price access settings? No, I'm not. Okay, I'll find it. The point is, and I have it here on my phone, as you can clearly see, from the moment that you would have taken this call, you would have been happy for a couple of days, right? Remember, you're this jittery paper hands trader. You're going to be, you would have been happy for a couple of days, and then you would have been extremely frustrated if obviously you were swinging this. So if you're going to swing this, each one of these bars represents a night that you're trying to catch some sleep, get some rest, and when you get these green bars, everything's fine. But when you get these red bars, oops, sorry, come back to that later. When you get these red bars here, you're going to be having a good time, right? And you're swinging this, and this particular option, I believe this is the picture. Okay, this thing, and I went over this in another video, but I kind of went over it really quickly. I wanted to dedicate a whole video for this. It cost me, it would have cost you, it would have cost me, sorry, $567. Goodness, what's going on with my throat? So, get this, you paid $567 right here. Okay, I'll put an exclamation mark on that. You paid, oh my goodness, why is everything so small on Thinkorswim? Sorry, I haven't used this in a while. Let's go for 30. Okay, so you pay $567 on November 22nd, whatever that date was. I think the 25th was a Friday, so that must have been 25, 24, 23, 22. That was a Tuesday. Okay, you paid $567 on a Tuesday, and then on a Wednesday, you're rocking because you're probably up. And then Thursday, Friday, next Monday, you would have been, actually, this is the 29th. That's weird because this 28th was a Friday, I'm pretty sure. But the thing is that you would have had some pretty bad sleep right around here because you're actually down now. You're actually down probably from the second red candle day right here. Pretty much at whatever point you came in on here. You would have been down already, and plus the premium, the theta decay. So you would have been down here. So you're suffering here, and you're suffering here as well. All right. So the thing is, how do you avoid, losing a good night's sleep? How do you avoid selling here? Because you wouldn't have sold here because you would have thought, and this is the hard thing to do psychologically, when you're using real money as opposed to when you're using paper money, like simulated trading. Here you're super happy, but here you're starting to get really worried. And you probably would have reached the break-even point somewhere on this day, at least on the low of the day. You probably would have sold here. That's what I would have done. Probably would have sold because you're thinking, I don't want to lose $567. I mean, yeah, it's 25 days out until December 16, but, here, you're break even or minus 10, you're like, oh, this guy messed up, the analyst, he didn't see something, he didn't take something into account, you don't have your own trade plan because this is an alert that you took. So you start to get really worried, and then you think, yeah, so maybe I'm down $10 or $20 right now. Maybe this thing's going to keep going down, because remember, you can't see these. This thing is going to keep going down. Let me bring up my picture so I can use it to cover the future, so to speak. So you're here, and you're down $10. You're like, I'm going to get rid of this thing. This was not the picture. That I just happened to use that $10. You start getting worried. You're like, well, this, if it was minus $10, this thing could go to minus 20, minus 50, eventually minus 500. And you start getting jittery. You start getting worried. You don't get enough sleep. You snap at people around you at work, at the office, whatever. Okay, so how do you avoid this? Because then the next day you're here, and then you're probably down like $100. I believe I was down 80 here. I was down 60 here. I was down 80 here or more, and then on this day I was down up to 100. And I was honestly, the reason why I didn't cut it is because I did what I did, which is what I'm going to show you today. Okay, so obviously I did not know that this was coming. All right, okay, so this is basically what we want to avoid: how to sell out too early and probably end up taking a loss, when this thing could definitely bounce back. So what did I do? All right, obviously this picture gives it away. Okay, I bought the call for 567, which is what the trader, when he looked at this bullish hammer, jeez, oh my goodness, when he looked at that bullish hammer, he figured this thing was going to go up. That's why he went for the 330. It was pretty far away, so it was probably not as expensive, as a 330 call, maybe at the end of November or beginning of December. So he probably went for that. I'm sure he looked at the delta as well. That surely played into his decision making. And so he alerts, hey, 330 call. Let me see. Do I have Discord open? I don't have Discord open. But the buy to open BTO Netflix December 22nd 330 call at whatever 567 or at M, whatever the alert was. So this is what you normally would see. Okay, let me go ahead and open Discord just so you go ahead and have that thing trying to open in the background while I do this. Okay, so remember, here, if you would have taken the 567 call and just that, then you probably would have been happy throughout the first day, the second day, okay? And that's probably where your good night's sleep ended, okay? So what I did, because I didn't feel like losing $567, what I did is I turned it into a vertical spread in this case, okay? Actually, oh goodness, okay. Log in, hold on. Need to use my phone here real quick. Sorry to interrupt the video like this, guys, but I want to show you that. Okay, there it is. Yes, I'm trying to log in. Yes, I authorize whatever. Buy me dinner. Okay, so I just want to make it as real as possible. So I'm trying to get all the details of a real live experience. Okay, and I could probably even BTO Netflix. Let's see if I can find that specifically in the alerts channel, analyst alerts. BTO Netflix, that wasn't it, obviously. Plus that's November 17th. That should have been it. I wonder if I could do like BTO Netflix December 16, I guess. 3:30, I'm guessing. Okay. Let's see if that will find anything. Nope. Alright, well, like I said, I'm not sure. I'm thinking it was a time hawk alert. It definitely wouldn't have been the Shinmun one because that's for November. List alerts. Okay. Well, I'm not finding it here, and like I said, that's not gonna be earlier than that. So that's kind of weird how it did not find it. Okay, so you see the alert, you see the long Netflix December 16, 3:30 call. Okay, so yeah, you could take just the call and then suffer through those $567. I believe at some point this thing was down to like, I don't know, like maybe $200 or $100 even. That's why I was trying to get the Thinkorswim thing to work, to check out how, what a roller coaster that thing was. And so this thing was down quite a bit, and then this thing was obviously up the other way. Now this is the other thing that I want to look at. Okay, so this is a sold call. All right, and that is what I want to go and check out over here. Analyze. Okay, so what happens? This is a Netflix December. Oh, there it is. Oh, interesting. Okay, so there is the call. That's the one that let me get these other things off of. Okay, so that's a sold call, okay, as opposed to a long call. Let me just get the long call on here first, because this is the picture that y'all should recognize. So this is a call. So the bottom part of the hockey stick here, that's the one where you pay $567 for this particular call, and after it breaks to 3:30, then your call is obviously worth more money. Why? Because you have the right to buy at 3:30, but it's above 3:30 now in the market, so you can quickly turn around, buy it at 3:30, and boom, sell it for 350, or 333. Sorry, here, or 340, or 350, or 360. Okay, obviously the farther away from the strike price or the contract price, okay, the price that the contract says that you can buy at 330, the farther away the current market price is, the more money there is for you to make. That call is more valuable. So this is why the call chart looks like this. Now that's a long call. Now a short call is actually the opposite. Okay, this is something you buy, or sorry, this is something you do. You sell it when you think a stock is going to stay below a particular level. Instead of being above 330, you're saying this thing is going to stay below 330. Why? Because this thing loses money after 330. If it goes above 330, you actually lose money. So it's the opposite trade. All right. So going back to our example over here, what I did was you buy the long call for 567, and then you sell a strike above 335 for that call, okay, or for that same contract. Sorry. So when you sell it, the reason why this chart looks like an inverse hockey stick is because you sell, so you lose. Of course, this is only 64 cents now. Let me get something in here. I mean, you can still see it. It's just not as noticeable. Okay, this blue line, that's what you get because you're selling a contract. You're not buying a contract now like you normally do. You're selling it to somebody. Somebody else bought it. They paid you, right? Same as the opposite of what happens when you buy a contract. You buy a contract, you pay them. And if that contract goes up in value, you pay them 10, that contract is now worth 20, then you made money. Okay, but in this case, you're actually selling the contract. Okay, so you sell the call contract for 64, which is what the price was back here, whatever this thing was, 64 cents or $64. Okay, you sell it for 64. You get to keep that 64, which is why this is a straight line, at any point below 330. Okay, because the guy, think about it, you sold it to somebody who bought it expecting this thing to go up. Okay, if this thing goes up, he makes money. Okay, if this thing goes down, his contract, the one he bought, the one you sold him, is worthless. Because if this thing is at 320 and he has a contract that allows him, remember, he bought it, he has a contract that allows him to buy this stock for 330. Why would he buy it at 330 if it's currently at 320? It's worthless. The contract that he bought from you is worthless. So this thing, this 64 right here, this straight blue line, okay, that's what you make if you sell that contract. And if it's below 330, you get to keep all of that money, which in this case is only 64 because this is a different example, and this is obviously dated, not the same date as when I sold that 335 call. So basically, he's going to have a worthless contract, and he's going to let it expire because he's not going to go ahead and buy at 330 when he can buy in the market at 320. It wouldn't make sense. So he lets it expire. It expires worthless. That means that you keep those $64 that he gave you when he bought the contract from you. Okay, so I hope this is not confusing. It's just the other side of, because we're normally focused on longing calls and longing puts. Okay, I'm going to go long a call if I expect it to go up. I'm going to go long a put if I expect this to go down. Well, you can also be short a call if you expect this thing to go down or stay below a particular level. Okay, this is also a strategy used for other things, such as making money from a stock that you have made enough money at 330, and you're basically betting, if it goes up, then that's fine. But if it stays down, then I'll go ahead and just make 64 extra dollars on top of my investment. If it goes up, then somebody's going to exercise that contract because it's not worthless anymore. Remember, it's worthless from here down, but it's worthy or valuable from 330 up. From 330 up, they'll exercise it. So if they exercise it and you've already made 20% on your stock investment, then you don't care because you made 20% on your stock investment. It got called away at 330, plus you kept or made 64 extra dollars. Okay, but that's a different strategy. So what do you do when you see this? When you see I'm long a contract, of course this is a put. That's not the best example because of what we had. Here, I'll use this XLF. Okay, that's also a put. Never mind. Why can't I find the right examples? Puts at the end of the day. There, finally, so when you see buy to open a Netflix December contract, then you could go ahead and buy it for $567 and kind of, bite your nails every night because you're swinging this thing all the way from November 11th to December 16th, about 20 or so trading days. You're swinging this thing, and every night you have to go to sleep. If this thing started going down, then let's do this. Let's use Discord now you only have that, okay? And if this thing went down, then you're not going to have a good night's sleep, right? Okay, so what do? You take the contract that you bought, you add you go and you look for the next strike, okay, the next strike up, and you sell that next strike up for the same date, all right? So what's going to happen? When you sell a call contract or sell a put, in this case a call, when you sell a call, you get money, okay? So that $467, you're not paying, you're actually getting that money for having sold that contract, and it goes back to something like this. If it stays below the strike that you picked, which was 335 in the case of Netflix, you keep the 467 because, again, the buyer of the contract you sold is not going to want to buy below 335 if it's currently at 330 or 320. They're only going to want to buy at 335 if it's above 335, if it's at 340 or 350, because they get to buy, according to their contract that you sold them, they get to buy from you at 335, and they can turn around and quickly make 25 bucks or 25 bucks. Sorry, 15 bucks by selling it at 350, in the market. Okay, so let's go and look at what happens here. So how do you avoid having, the daily jitters of, oh my God, am I going to lose all 567? Is this thing has gone down to 184? This is what goes through your mind. This thing has gone to 184. It could go down to 200. So maybe I should exit now and take the 184 loss. Or maybe I should hold out because I have 25 days. This thing could bounce, right? It could bounce, and maybe it could go down only to $100 loss. And a $100 loss is better than 184. Maybe it's just a matter of time. But in that psychological, war game going up in your head, it could go down to a $100 loss, but it could also go, down to a $284 loss. And eventually that could reach 567. It's amazing how your mind, when this thing reaches 184, and then you're like, I'm okay, because it could bounce, right? And then next day, 284, crap. Okay, well, now what you think, it's kind of crazy if you think about it. Now you're thinking, oh, well, it's 284. I'm definitely not going to sell now because I'm not going to lock in the loss of 284. So you convince yourself to give yourself another day. And then it's 384, and then another day, and then it's 4, and before you know it, you're down to 0. All right? So psychologically, you have to have a lot of technical indicators and levels and rumors and fundamental analysis and a whole bunch of stuff, including luck, that will help you become diamond hands enough to say, this thing, I'm losing $200, $300. It could go down to 567 if I don't do something about it, and you end up convincing yourself to do something about it because this thing could reach the bottom here, or whatever. So it's really easy to convince yourself to actually keep losing. That's why you don't have to do that. You don't have to do that if you sell that call on the strike above for 467. So what have you done now? Well, what you've done is you have, and I'm going to bring out the calculator here, you paid $567 for that long call, which may or may not get to 330. But you collected, so minus 467, okay? So you actually only paid $100, okay, or 1.00, if you want to look at it that way. So that means that two things. Number one, that this is your maximum loss. Okay, this is what you are risking. You are risking $100, and that's it, no more. All right, that is the maximum amount of money you can lose, because if it's above 330 and this thing is totally green, but this thing is red. Okay, if it's below 335, then this thing is green, but this thing is red. All right, so they balance each other out, but not exactly, not completely, okay? Because think about it, if it is indeed above 330, let's say that it goes all the way to 360 or whatever, then this thing is going to be worth a whole lot more than 567. But the maximum you can lose here is 467, okay? So you've basically limited your risk from $567 to $100. That is a big relief, because that means now that this number here, that's not a text note what I want. Okay, so now 567 becomes 100. All right, that is a lot easier to live with. Okay, and that's going to help a lot when this thing starts tanking or retracing or pulling back or whatever you want to call it. All right, that's the whole point. Okay, so what we've done, we sold that thing that 335 call, if we go back to the analyze, okay, see if this is going to work in here. So we throw that in there, a long and a short Netflix. That's an option, and that's a what? Let me go ahead and just throw it in from the beginning. Let me go over to the trade, and oh wait, I think I have it in there. Sorry, I missed that. Let me go back to analyze. Yeah, it's just the ones in the middle. Okay, sorry. All right, so there it is. Okay, and that is what a vertical spread profit chart looks like. Here's your long call. Okay, if it goes up, you're good. Okay, but it gets capped. Okay, that long handle on the hockey stick gets capped right here because this is your short call. Okay, so basically what you want is for it to be somewhere in here. If this is the 330, remember we're looking at a 330, yep, and a 335. So you want it to be between 330 and 335. Okay, that's where you're going to want this thing to go. And basically, if you go back to the chart, okay, what happened here was that I was down about $100. Okay, I was down about $100, so I was basically at my max loss. So at that point, I'm thinking I'm just going to leave this thing. You know, I'm not going to mess with it. At what was this? 280. At 280, okay, I'm well below the 330 strike, so the long call is not making any money, and I am below the 335, so that is more valuable, but it can only be valuable up to 467. So if this thing ends up losing, okay, this total loss is 567, this total gain is 467, so your max risk, or your max loss in that case is $100. Okay, so the point is that at this point, if you're only down 100 instead of 567, then that it's only $100 will help you with your jittery hands, and you'll probably do what I ended up doing. What I ended up doing, but I did it on TradingView, was I started charting, okay, what can I do? You know, you could manage this thing at a certain point, because if this thing is dropped down to 280, and the sold call is obviously profitable, okay, because that's the one, if it's at 280, it's definitely below 335, so this is the green one. So then you start thinking, okay, I'm going to go ahead, buy this one back, make $174 on it, and I'm losing 184 up here, but this thing could become more valuable from 3.8. It could go to 4.8. You know, maybe not to 567, maybe not above 567, but it could definitely go from 380 to 480. So that's $100 more. So if you made 174 when you sold and bought back that call, you made 174, and then you add to that $100 that sold, the bought call at a 184 loss. Let's say that it goes up to 300, so maybe that bought call, instead of minus 184, is only minus 84. So it's up. You're only down $84, and you made 174. So 174 minus the 84 that you're now down, you're actually up $90. So that's one strategy. You get rid of the bottom leg, and you keep the long leg. Okay. Now you got to be careful, because I got to switch out of this drawing tool. Hold on a second here. This thing's driving me crazy. Okay. What you've done here, if you get rid of that sold call, this thing better bounce, right? Because if it keeps going down, the sold call is the only one that's going to be increasing in value, and you don't have it anymore because you cut it loose. So you don't want that. So you have to be careful. If you do decide to cut this short leg, then you better be sure that this thing is going to go back up, and then that loss is going to be reduced in such a way that But because if it keeps going down, you're basically uncovered to the downside because you got rid of the only thing that was green to the downside. So the other thing that you could do is you could buy back this call, okay, the 335, and go ahead and sell maybe a lower strike, maybe not 335, maybe 300, right? So now, instead of expecting this thing to go to 330, you're expecting it to stay below 330, sorry, you're expecting it to stay below 300, all right? So this is your roof now for that short call or that short leg. If this thing goes up, but it doesn't go past 300, then you made 174 when you bought this one back. And because it went from 280 to 300, then this thing is definitely going to be smaller than 184. So it's going to be more profitable. More profit that you can add on top of the 174. And this other 300 call that you sold will be profitable as long as it stays, Netflix stays below 300. So it could have bounced to here. So if I would have done that yesterday, which I didn't do, if I would have done that, or not yesterday, but the day before yesterday, then I would have sold I would have bought back this one, pocketed 174, I'm still down 184, and then sold the 330. And the 330 was running $425. I could have gotten 425 new dollars on top of the 174. Okay, 425 new dollars for a sold call that needed Netflix to stay below 300. So on the next day of that trade management that I would have done here, I would have lost money because this thing popped over 300. And then today, the second day above, after I would have done that management, then that would have also incurred in a bigger loss, okay, because it's above 300 on both days, on this day and on that day. Okay, so you got to be careful either way. If you just buy back the short leg, then you're going to have a risk to the downside because the short leg is the only thing that profits to the downside. If you sell another short leg, then you have a problem to the upside. Okay, because those sold calls or those short legs, they only profit to the downside. They lose to the upside. So you got to be careful when you do these vertical spreads. But the point is that if you keep it as a vertical, if you keep it as a vertical, the amount of money that you can lose drops dramatically, more than 5 times, from $567 to $100. That is a lot more palatable. That is a lot easier to digest every night before you go to bed. All right, and that's what happened. This one was actually a picture that I took somewhere, I believe, around here. Okay, I'm pretty sure it might have been here. I'm not entirely sure. Actually, I have the picture on my phone, so it should tell me the time I took the picture. Oh, but I erased it. Okay, so never mind. But the thing is that at some point, this thing was down to $100, and I let it ride a little bit because $100 is not as terrible an amount of money to lose as $567. So that allowed me the confidence and the leeway, the mental leeway to say, okay, I'll let this thing ride. Because, I'm not going to lose any more than 100. That's what the vertical cost. It's not going to be any more than that. It's definitely better than losing 567. So then I believe I took this one yesterday, this picture. So by end of the trading day yesterday, this thing had gone from minus 100 to minus 10. All right, and then today, which is here and here, which is actually here, I was able to get out of that trade for green. Let me see what I'm looking for here. Okay. Okay, so now here it is. All right. It was this one had gone from 3.8. Remember that? It had gone from 3.8 to 6.7. So it had basically doubled in value. Of course, look at that run, right? And this one, which was down 100, up 174 was now down, but only 65. So now I was up 40, all right, and 40, if I didn't do the numbers, to be honest, 40, right? Well, okay, duh. Well, 40 over 100 is 40%, all right? So I was up 40%. Oh, it's right there, but you can barely make it out. So I was up 40%, all right? So, and that was like, okay, that was like at 9 a.m. I definitely could have held out for longer. Let me move this time frame down to the hourly, all right? So this was today. I think I need the arrow for this one. That's what I don't like about Thinkorswim. All right, so here's the opening. All right, and 9 o'clock my time is actually, yeah, 30 minutes after open. So yeah, pretty much somewhere around here. All right, is where I sold. So it did. I missed out, like, let's say, on this amount of profit, but then it, it kind of started wiggling around. So back to here. This is what that's when I decided to go ahead and take that vertical off the table. All right. I wonder why I have a third picture. I think it's the one. Okay, that's what I sold it for. All right. So I actually sold it for 139 instead of 140. Look at this. Look at it. You want to see a jittery trader? There you go. Down here, I think I set the actual the mid price, which was 142. I think it was 142. And I was like, oh, this thing is, oh, it's going up, it's going down. Okay, no, I'll take 141. And then it was going lower. And I was like, oh, no, I'll take 140. And then I ended up going for 139. Okay, so that's a jittery trader for you. And that's fine. If you recognize that that's what you are, if you identify, if you accept it, that's fine. But do something different. Don't keep trading single or naked alerts, as they're called. Don't just go for the, BTO SPY 407 at 228 because 228 might not be a number that you want to swing. It might not be a number that you're comfortable going to bed at, a 10, 20% loss. But this thing can turn around, and the fact that you made it into a vertical makes it more bearable, basically. Okay? So remember, what you do is, if we were to take, let's go ahead and go to the trade, December 16, if an analyst says, actually, let's look at the chart. Let me get out of here, the zoom thing. Let me go back to the daily. Although, all right, okay. Let me go back to this daily here. I don't know if I want to go 1 year daily. No, that's too much. Let me go for the 6 month daily, or 3 month daily, actually. There we go. That's a lot better. Okay, so this is, let's go ahead and do some quick TA. It hit resistance once, hit resistance twice, hit it 3 times. Okay, I didn't do the 6 month, probably more. But at this point, I would probably take a put vertical instead of a call vertical, because I would take a put. A vertical is just a way to limit your loss when taking the call is too expensive or taking the put is too expensive. And then in exchange for capping your profits. That's basically what it is. So that's what allows you to be a little bit more relaxed with your trade. Now you could imagine that if I want to buy a call right now, because this is extended to the upside, a lot of people are probably expecting this to go back down, not to go back up. So let's say that we want, let's switch over to the 6 month to see if we can get one more level in here. Nope. Okay, that's fine. Let's do the 1 year. Okay, so here's a level. Let's go ahead and draw that price level in right here. So there's a price level. We'll go somewhere there. Okay, so now let's zoom in. Actually, you know what? Let's draw another level since we're here. That's a nice one, actually, right All right, so there's two more levels. All right, so let's just use those to get a feel for how, oh, we're going to have to do 6 months, for how this might work. Okay, so somebody might say, okay, this thing could go to 351, 350. Let's call it 350. You could also say, okay, that's a little bit too far. Let's keep an eye on 330. All right, fine. Let's go to the trade. And December 16, why not? Remember, this is simulated trading, so it doesn't matter. 300. We said, sorry, we said 330 and 350. So look at the 330. Okay, you want to buy a call for December 16 on 330 after this thing has been rocketing or mooning or whatever you guys call it, right? It's very likely it's going to hit 330. Probably not so much at 350, but it's definitely likely it's going to hit 330. So what happens is that premium goes up because a lot more people think that this thing is going to go to 330. Would you buy this? Would I buy this? I would probably buy this because the delta, or the probability of this being in the money, is 36%. Anything above 30 is one of the parameters that you use for buying options of a standard risk. Okay, so would I buy this? Yes, but $735 is really expensive. I don't want to have to pay $735 and then sleep at night and worry about this thing going up and down and then keeping me from sleep. So what do? I look for the next price, the next strike price above, and I sell it. So I believe it's command, okay, and then that one. Nope, that's not it. Okay, so I already had it, so I think I just click on it. No, that takes it away. Sorry, I haven't used this in a while. It's probably shift. All right, you know what? I don't know what it is. I can just come in here and buy custom. Vertical. Sorry, that's what it is. Okay, so it puts it together for me. I can do it manually, of course, but apparently not, right? So I buy the 330 call, so that's I'll buy, but then I sell the 335, the one above it. All right, so I'm buying the 7, and instead of risking $735, I'm putting down $735, but I'm also getting $565. So net debit, or total debit, is only $150. It's only $50 more than the previous one. Okay, so let's go and analyze this trade so we can look at that profile I was talking to you about. Remember, 335, which is right around here, 335, and what was the other one? 335 and 330, yeah? Okay, so here's 330, here's 335, okay? That's your max profit. That's your max profit right here, okay? It gets capped because you took the short call, all right? So that's your max profit right there, all right? Okay, so that is how you basically make the trade. Whatever alert you see, you sell the call one strike above that, all right? And that's how you end up with a 150. So because we're here, I'm gonna go ahead and confirm this. All right, and there it is. Your max profit is 350, which is the difference between the strikes. This is a little bit more technical, but might as well throw it in here. I already went over 30 minutes, which is my original allotted time. 335, obviously, minus the 330 is $35. Okay, so, and you're doing, excuse me, the 330 and the 335. Sorry, I didn't do that right. 335 minus the 330. All right, that's five. That's the $5 spread minus the 150 that it actually cost you. That's $350. $350 is your max profit on a trade like this. So you're putting down 150 to make 350. That's basically 1 for 3. That's not bad at all. All right. So we're gonna go ahead and send this just because it's simulated trading. I might look at this later on, but I basically wanted to explore that option with you. All right, there it is. It's because it's not trading hours, then it won't actually execute it. So, it'll probably go ahead and execute tomorrow. Hopefully, it won't open. The market won't open too high tomorrow. So, but we already analyzed what we needed to analyze, which was basically, how do you turn this long call and then give yourself safety to the downside? Because if it stays below this, if it stays below the 330, then you make money from the short call. If it stays above 330, then you make money from the long call, but only up to that strike. All right, so I hope you guys enjoyed this, and if you have any questions or any other strategies that you want me to cover, I would be glad to. I'm going to be focusing probably on verticals and some other kinds of spreads later on in the month of December, and I'm hopefully going to be making some videos on more detailed charting, talking about confluence, and as I mentioned in the previous video, I'm going to be looking at the complete trading strategy and kind of piecing it all together for you guys. Alright, so I hope you enjoyed this video. Remember to subscribe to our YouTube channel. Remember to check out the X-Trades web app as well as the mobile app, which you can customize to give you alerts on specific analysts. If you only want alerts from a specific analyst on specific types of assets, whether you just want options or you want stock alerts, or if you want swings or day trades only. So it's very customizable. It's a lot better than just following the Discord alert channels, but check that out for sure. And if you think you need extra help, remember that you can sign up for mentoring with us in the X-Trades community as well. So go ahead and shoot me a DM, and I'll get you hooked up, or I'll help answer any questions you might have about verticals or about single option contracts in general. Alright, so I hope you enjoyed this video, and I'll see you in the next one.